All right. Hello to all the Cubs of Wall Street. Today we will be going through some of the basics of stocks and investing.
Before we begin, I'd like to introduce InvestBright. We're basically an organization that makes financial and business literacy simplified and accessible for young students.
So, what is a company?
Simply put, a company is an organization that sells a product, like the iPhone or Roblox, or a service, like finance or hospitality.
So let's start with a quick example of a small and starting company. Do you guys remember Jay from the case study? If you haven't checked the case study out, visit our website at investbright.net and go to the competition materials tab. And under that, you will find a tab called the case study. So this is the same Jay, flashback a few years. Jay was starting a lemonade stand and he wanted to provide some lemonade in his community during the hot summer months. And his main goal was to make a profit and to earn some money through that.
As word gets around about the lemonade stand, Jay's uncle and his best friend want to get involved and help him sell more lemonade. As the way he makes money is selling lemonade, the way he decided to sell more is hiring employees and buying stands to sell more lemonade at once. To do this, he will need some more money. What Jay does is offer them a part of the profit in return for their cash.
So what Jay has done, essentially, is issued a share of his company to his friend and his uncle. He splits his company into 100 shares and sells 5 shares to each his uncle and his friend at $5 per share. He raises $50 for his business in the process.
So what is a stock or a share, and what does all this issuing a stock mean? That basically means that Jay has allowed his uncle and his friend to buy a part of his company at a price. This means he has issued a stock to them. Buying stocks of a company means that you're essentially owning a part of a company and a small part. And you once you do that, you become a shareholder or an investor in that company. So over here in this example, when Jay's uncle and friend put money into his company or his lemonade stand, they became investors or shareholders of his lemonade stand business.
Jay makes a lot of profit and his business goes to the moon. He makes a ton of profit and now has many options like using the profit to grow more or return a share of his profit to the investors, his uncle and friend.
So, the stock price is a direct reflection of the valuation of the company, since the value of a company is stock price multiplied by the number of available shares. This is what we call market cap. Market cap is very easy to calculate, and all it is the current market share price times the number of total shares.
So coming back to Jay's example, Jay's lemonade stand did have a certain market cap. So he sold five, as you might have read, he sold one share for $5, and he issued say 100 shares. So out of those 100 shares, he himself owns 90 shares, and he gave 10 shares to his uncle and his friend, who got five each. So now he sold 5 shares with one share sold at $5. So that gives us 5 shares sold at $25 because 5 multiplied by 5 is 5 or 25. And with this, when his shares became, so when he sold each share for $5 and he's issued 100 or he has total 100 shares, his company is going to be worth $500 because he has 90 shares, his uncle and friend have 10 shares, total shares are 100, and each share is worth $5. That puts his company or lemonade stand's market cap at $500.
More people join in. Why invest? Jay started selling his shares to the public now. IPO covered later. His dad was working the day Jay sold his first few shares, but he wants to jump in. Jay offers him a share at $10 this time, and his company value has increased because of how successful it is. His market cap is now $1,000, and his uncle and friend can sell their shares at $10. That gives them a $5 profit. Selling price minus buy price equals profit. So 10 minus 5 is 5. You invest to make profits like this.
So, the stock market and stock prices. The term stock market can basically be used interchangeably with stock exchanges. Now, you may be wondering, how do I actually go out and buy my own shares of companies? Well, you can use brokerages and apps like TD Ameritrade or Robinhood, which you can access on your computer or your phone, and access these stock exchanges and start trading yourself. However, you do have to be either 18, or if you can't wait to get started, you can ask your parents to open a custodial account for you. And a stock exchange is just, as it says, a marketplace of stocks. For example, one would be the New York Stock Exchange.
Let's cover some basic supply and demand and look at an economic aspect of investing here. So supply and demand is a key concept to economics, and it is applied in investing quite well. So let's start by understanding what that actually means. So say a shopkeeper has 5 apples and 10 people want to buy it. Now, if he only has 5 apples, but 10 people want to buy it, then looks like he's going to have to raise the prices of those 5 apples so that only the 10 richest people, or the 10 people who can, or the 5 people who can afford it, are going to buy that. So what he only had 5 apples, or his supply of apples was only 5. That means he had a limited supply. But 10 people wanted to buy it. That means there's a high demand. 10 people is more than 5. So there's a high demand while there's a fixed supply. So when you have a fixed supply and high demand, the price is gonna go up of the item. Now, say the shopkeeper has 10 apples, but only 5 people want to buy it. And he wants to sell all his apples because, if he keeps it for too long, then they're going to get spoiled. So what he's going to do is he's going to give 2 apples for the price of what 1 apple would have originally costed. So he has 10 apples now, but the demand is not 10, it's 5 people want to buy it. So he's going to have to reduce the price of the apple into half. So when you have a fixed supply, but you have a decreasing demand, that means less people want to buy it, then the prices are going to go down. So let's see how this applies to the stock market now.
So, how does the stock market move up or down? For every stock transaction, there must be a buyer and seller. If there are more buyers for a specific stock than there are sellers of it, the stock price will go up. On the other hand, if there are more sellers of the stock than buyers, the price will go down. This is called supply and demand, as we have seen in the previous slide. So for example, if there are more people that like Jay's lemonade business idea and want to buy a piece of it than people who don't like his business and want to sell their shares, then that would drive the price of the share up because more people want it. If there are more people that want to sell their shares of Jay's lemonade stand business because they don't like it for some reason, like maybe they aren't selling enough cups of lemonade, or maybe Jay was involved in some scandal, then the price of the stock will trend down because people don't want to buy into his company.
All right, so let's go back to the initial public offering. This basically just means, how does a company get on the stock market? An IPO is when a company is listed publicly on the stock exchange so that regular people like you and me can buy it through brokerages. Like mentioned before, we can buy it through Robinhood, or we can buy it through TD Ameritrade or any other brokerage app.
So let's understand one of the most fundamental concepts in business and finance, the concept of risk. So risk is the possibility that something could go wrong. When Jay started his lemonade stand, there was always a possibility that, the summer months could suddenly get cold because of a hurricane or some weather event nearby, and people don't want to drink lemonades. Or maybe people have discovered that Jay's water supply isn't very fresh, so they don't want to buy lemonade anymore from him. So risk is anything that could go wrong, that could affect your business. So if any of these things happen, for example, then there would be a high possibility that Jay's business wouldn't take off. If the day Jay started his lemonade stand, if the next few days were very rainy and cold, then there might have been a chance that Jay couldn't have grown to the potential that he grew to. So if you look at companies now, like Apple, there are several forms of risk. Like, for example, people are starting to realize that maybe the iPhones aren't getting as competitive or don't have as many cool features as other phones, like maybe Google in the future, if they have some more complex advancements in their AI or in their phone, if they have more cool features, or if, for example, Apple right now is getting battered for privacy issues along with Facebook. So things like this, if these are all aspects of risk, and once these come out, these can definitely affect stock price. Let's see how.
When you invest, there's a policy that the stock price could go down because of things like legal issues, as covered in the previous slide. Fortunately, risk can be managed through diversification and other strategies under the umbrella of hedging risk.
So, diversification is one of the main types of methods that someone can use to hedge risk. Diversification is when you spread your investments in different companies so that your exposure to any one type of risk is limited. A diversified portfolio is designed to help reduce the volatility of your profile over time. Volatility just basically means that your portfolio will go up and down. It may not go as high up as you would want it to. Diversification generally means that you spread out your capital, right? Your money over a range of different industries or different companies. So if one risk is affecting one company, it doesn't risk your entire money or your entire capital.
So in the previous slide, you heard the mention of this term called hedging, and you might be wondering what that is. In simple terms, hedging basically means reducing risk. So, for example, by that, if you had the choice of investing in Jay's lemonade stand, his newspaper distribution business, or his dog sitting service, would you just invest? Would you put in all your money in just the lemonade stand, or would you spread your money out across all three businesses? Now, let's see how you can hedge or reduce your risk by spreading your money across all three businesses. So, for example, you would invest in his dog sitting service and his newspaper delivery business and his lemonade stand. So if you invest, say, in his dog sitting business and his lemonade stand business, then if in 1 week, in 1 week's time, the news channels have said that it's going to be really cold, it's going to be really rainy, and people aren't going to be in the mood for drinking more lemonade, then wow, you just got saved because you have some of your money in the dog sitting business as well. And more dogs are going to stay home now because it's going to be raining. So you have a better chance because so more people are going to use that service, and Jay's going to profit more. So that's going to increase the total value of that company more. So that means the stock price of that company would go up. Whereas in the lemonade stand example, you might not, people are not going to buy lemonade anymore. So Jay's not going to make as much profit, and the value of his company is going to go down. That would eventually lead his stock price to go down. So by splitting your investments, you have gotten stock price increase in one while you've gotten a stock price decrease in one. Whereas if you had your money just in the lemonade stand, then all your money would have been decreased rather than having some amount of increase in your money as well. This is the main concept of diversification, and it's super important to understand.
In this module, we went over the basics of what businesses are, what stocks are, and how their roles are intertwined. In future videos, we will also cover stocks and how they affect you, the economy, and what plays a role in the financial markets past stocks.
So, to sum it up, we went through the example of Jay. Jay made a business, he raised money for it, it grew in value, it became public, and it kept growing. This is a cycle that every single company in the financial markets goes through. However, conversely, if it doesn't grow, it doesn't keep succeeding, it'll go down, and public support for it will also go down. So any business can go two ways. And this is why each business has to continue striving for success when it's on the market.
Thanks, guys, for watching this video. We hope you liked it, and we hope your concepts got a little more cleared up. This stuff is really complex to understand, and a lot of people, even adults, are confused about how this all works. So, to help you out, we're hosting a live class on Monday at 5 p.m. Pacific time. If you're an international student, don't worry. We will post a recording of the live class, or we will hold an alternate session for you that works with your time. Please email us if you would like that. Otherwise, thanks for listening, guys. We hope to see some of you on Monday, where we will clear up any concepts you have, any questions you have, and talk about more depth of these topics. Yeah, let's keep in contact. Follow us on Instagram at InvestBrightOfficial. Visit our Discord server, where we have a community of budding middle school investors and high school students now as well. And check out our website as always for important updates and where you find this information. We will be sending out mailers with important information periodically, but most of our content is going to be under the competitions material tab on our website. We hope you enjoyed this video, and that's it with round one, week one. Bye bye.
Bye. Thank you all.
Thank you.